Today, we're going to talk about one of the most important principles in investing, portfolio diversification. Whether you're new to the stock market or have been investing for years, understanding how to properly diversify your portfolio can make a significant difference in managing risk and achieving long-term growth. First, let's define what diversification really means. Diversification is the process of spreading your investments across various asset classes, sectors, industries, and geographic regions to reduce the impact of any single investment performing poorly. The core idea is simple. Don't put all your eggs in one basket. Why is diversification so crucial, especially in the U.S. stock market? Markets are inherently volatile. Individual stocks can drop dramatically due to company-specific news, economic shifts, or broader market corrections. By diversifying, you lower the overall risk of your portfolio without necessarily sacrificing potential returns. Historical data shows that diversified portfolios tend to experience smaller drawdowns during market downturns and recover more steadily. So, how do you actually build a diversified portfolio? Start with asset allocation. A balanced portfolio typically includes equities, primarily U.S. stocks through broad market index funds or ETFs like the S&P 500, which give you exposure to 500 large-cap companies across multiple sectors. Fixed income, bonds or bond ETFs to provide stability and income, especially during stock market declines. International exposure, add global or emerging market ETFs to benefit from growth outside the U.S. sector diversification. Within stocks, avoid overconcentration. For example, don't load up only on tech giants like Apple, Microsoft, and Nvidia. Balance with healthcare, consumer staples, energy, and financials. Alternative assets. Consider small allocations to real estate investment trusts, commodities, or gold ETFs for additional protection against inflation. A practical example. A moderate risk investor might allocate 60% to stocks, 30% to bonds, and 10% to alternatives. Adjust this based on your age, risk tolerance, and goals. Younger investors can lean more towards stocks, while those closer to retirement favor bonds. Remember to rebalance regularly, at least once a year. As certain assets outperform others, your allocation drifts. Selling winners and buying underperformers keeps your risk level consistent. Finally, diversification is not about eliminating risk. It's about managing it intelligently. Even the most diversified portfolio can lose value in severe market crashes, but it will typically recover faster and with less damage than a concentrated one. This is general education and not personalized financial advice. Always consult a qualified financial advisor before making investment decisions. Thank you for watching. If you found this helpful, like and subscribe for more investing insights.